Hi everyone, this is the last video on risk. I didn't expect to film it tonight, but it's just beautiful. So I wanted you, before I talked about risk, just to, voila, there's a little bit of sun, it's a little bit cloudy, there are cows over there, I don't know if you can see, but I wanted to share this moment with you. So, liquidity risk. What's liquidity risk? The definition of liquidity risk is very simple. Liquidity risk is the inability of the bank to face its commitment. Okay, we have a commitment, we cannot face it, it's liquidity risk. For example, some clients have some deposits at the bank. They ask for the deposits back, we cannot give them back, liquidity risk. I have some debt to pay back at the bank, I have some debt to pay back, I cannot pay it back. This is also liquidity risk. So the inability of the bank to face its commitment. You don't see it, but I have a tree right there where I put some stuff for the birds to eat. Right there. And it's very nice, and you can hear them. What was I talking about? Liquidity risk. So I gave the definition. I don't know if you remember summer 2011. Summer 2011. No, some are thinking, yes, I was on vacation. No, summer 2011, it was the European debt crisis. And at that moment, a lot of banks faced a huge liquidity risk. Let me explain. Let me show you again. I'm taking you with me. I don't know if the pictures are as beautiful as what I can see, but it's just the mix between shades and light, and it's beautiful. So liquidity risk, what was I talking about? Yeah, summer 2011, what did we have? We were very close in Europe to a liquidity crisis. Let me explain. We have deposits from clients. What do we do with the deposits? We lend them. So, for example, we receive deposits from clients. Let's say clients can withdraw the deposits whenever they want. But the thing is, we lend this money. We lend this money medium to long term. So we have a risk of transformation, meaning I receive some deposits very short term and I lend them long term. So if my clients ask for the deposits back, I have a problem because I lend them long term. So in that case, what do banks usually do? They ask the Treasury Department to borrow the amount on the interbank market. So they ask the Treasury Department to borrow on the interbank market if there are some deposits being withdrawn. Summer 2011, we have deposits, mainly in dollars. So what do? We lend them. Okay. The thing is, European debt crisis. The US start to get their dollar deposits out of the bank. Problem is, we lend them long term. So what do? We ask the Treasury Department to borrow in the market, and Treasury Department goes onto the market and say, "Hi, I'd like to borrow." And what do banks say? No, we're not lending you any money. What does it mean? We cannot borrow, so we cannot pay back the deposits. What does it mean? Liquidity risk. We cannot face our commitments. What would have happened if that would have been the case? It's very simple. If you cannot face your commitment, you go bankrupt. So liquidity risk is binary. You can either face your commitments, everything is fine, or you cannot face your commitments, and that's it. You go bankrupt. Okay, file for bankruptcy, whatever you call that. All right. So summer 2011, we were very close to bankruptcies for some banks. Following that, the Basel Committee said, well, that means you don't manage your liquidity risk correctly. By the way, there was already some liquidity ratios to follow, especially in France, but well, there was nothing for the whole of Europe. So the Basel Committee said, well, we're going to ask you to to apply some ratios for your liquidity risk. And there were two ratios in Basel III. The first one was the LCR, the liquidity coverage ratio. Le LCR, alors c'est pas la Ligue communiste révolutionnaire, c'est le liquidity coverage ratio. And there was another one called the NSFR, the net stable funding ratio, NSFR, net stable funding ratio. And the LCR had to be applied since 2000. It's applied and published since 2015, and the NSFR is I think it's I can't remember. Well, and now I'm just going to explain the LCR, the liquidity coverage ratio, very simply. What does the liquidity coverage ratio say? It says if you cannot borrow 1 cent in the market, no one's willing to lend you, you still have to be able to face your commitments for the next 30 days. So what am I saying? The LCR is a 30 days flow ratio. What does it mean? If you cannot borrow 1 cent in the market for the next 30 days, you still have to be able to face your commitments. What does it mean? First, you need to know what are the commitments you need to face for the next 30 days. What does it mean? You need to know all the cash outflows that will happen in the next 30 days. You must also know all the cash inflows that will happen for the next 30 days. And you must be able to face all those flows. What does it mean? It means that you must have cash or things that can quickly be transformed into cash to face those commitments. You must have high quality liquid assets to face your commitments. What's considered as high quality liquid assets, to make it very simple? Government bonds, corporate bonds, but all investment grade. I'm simplifying, but let's say debt, securitized debt, and investment grade or from governments. Voilà. So the ratio is what? You must know all the commitments you have to face for the next 30 days, and you must have high quality liquid assets to face those commitments. So the ratio between the two should be above 100%. Voilà. So this is the ratio. NSFR, if you have any question on the net stable funding ratio, you put a comment because you all subscribe to the channel, and I'll be very pleased to answer. Voilà. Hope you're well. And now look, what do we have now? Up, I don't know if you can see them. We got horses. Voilà. I wish you a very nice evening, because for me it's the evening, so I'm gonna go in my workshop, work on wood a little bit, and hope you like those videos. It might be one of the last. Lockdown is unlocking. I hope you're all fine, and I'll be very happy to see you in a training as soon as possible. For the time being, I'm taking care of the garden right there, and I'm working on my workshop. If you need some furnitures to be made, I make tables, I make any type of furnitures. I'll do a video on that, and so you can buy a lot of these. Voilà, see you soon. Bonne soirée. À bientôt.